we start with fresh numbers. The latest monthly jobs report, new data showing job growth slowed in March, but the U.S. labor market still remains robust.
Now, this report comes after the Federal Reserve raised interest rates for the 9th time in about a year last month in an effort to combat high inflation. The Bureau of Labor Statistics announced today U.S. employers added 236,000 jobs in March. That's 90,000 fewer than the number of payrolls created in February.
The unemployment rate, meanwhile, remained relatively steady last month. You see it there. It fell just 1/10 of a percentage point to 3.5%. President Biden called the latest data, quote, a good jobs report for hardworking Americans. Sounds pretty typical. Joining us now is Sarah House. She's a senior economist for Wells Fargo and can tell us if it really is good news. Because, Sarah, I think these numbers always come down to where are you in the economy, right? When we say, is the economy strong, do these numbers show positivity? So from your vantage point, where is the economic strength and where might be some of the weaknesses based on these numbers?
Right. So I think overall, we're still looking at a very strong jobs market. So yes, we saw the slowest rate of hiring in a little over 2 years, but the 360,000 pace that we've averaged over the prior 12 months just isn't sustainable when we think about the labor force and population trends in the U.S. So if we look at the overall numbers, I think it's still pointing towards a pretty warm jobs market, and particularly if you're in some of the services fields, which still have a little bit more catch-up room to do than perhaps in the good side of the economy that tends to benefit more from the spending pattern changes that we saw around COVID.
So we know that the Fed has made clear that tamping down inflation is priority number one. So how do you think this report will impact their decision on future interest rate hikes or perhaps cuts?
Right. So overall, I think the Fed's going to be pretty happy with this report. I think one of the key numbers we saw was that average hourly earnings, it picked up a little bit relative to what we saw in February. But I think on trend, we are seeing more discernible slowing. So average hourly earnings are up 4.2% over the past year. So that compares to a recent peak of almost 6%. So we're seeing inflationary pressures from the labor market lessen. And importantly, what's helping that is not just some weaker demand, which is what the Fed has essentially been trying to engineer with higher interest rates, but notably we saw labor supply improve in this report. So we actually saw the 4th straight increase in labor force participation. And so that's taking some of the edge off of these inflationary pressures. So I think overall, this keeps the Fed on course to hike again in May, another 25 basis points. But we do think that we're getting towards the end of this tightening cycle as we do see some weakening in the overall jobs picture and inflation along with it.
Now, that sounds to me like good news. You're talking about inflation pressures easing. Perhaps we're coming to the end of this inflationary cycle. Vlad alluded to, I don't know, interest rate cuts maybe in the distant future. And because these falling job growth numbers are what the Fed was aiming to hit. So when, Sarah, when might we see things begin to cool?
Well, I think we certainly are already seeing conditions cool. So if you look across a range of labor market indicators, not just what we saw out of today's report, but we've seen the number of job openings come down almost 20% from their peak. Same thing with some private measures of job postings. We now have the smallest share of small businesses saying that they plan to hire since 2017, if you exclude those depths of the COVID lockdowns in the spring of 2020. So I think we already are seeing that labor market begin to cool. But I think in terms of when things really start to get hairy, and I think when they start to concern the Fed, it's probably not until the 4th quarter of this year. So the Fed wants to see that labor market deteriorate a little bit because it has been generating inflationary pressures and making it difficult to achieve that price stability target. So I think the Fed's overall going to remain comfortable with some weakening here over the coming months. But I think by the end of the year, they're going to start to get much more uncomfortable. And we think it's possible we'll actually see the Fed cutting by the end of the year.
All right. Sarah House with that analysis for us. Thank you, Sarah.
Thanks, Sarah.